Hey everyone, welcome back to Upside Down Data. Today I want to talk a bit about Bitcoin and why further upside for it might be possible, just like what happened back in 2019 coming out of the 2018 bear market. So let's go ahead and jump in. So if you've been watching the markets, currently as I record this on the 15th of February, Bitcoin is going on a bit of a tear today. It's up almost 5% on the day, really kind of making back a lot of these losses that it had sustained, going down into the 21K level, currently up at around 23K. So what I want to talk about today is diving into some data that might suggest what we're doing now looks a heck of a lot like what happened back in 2019. If I just scroll back over to there, this big rally we saw. Now, I'll talk in a minute about why I think, a full 2019 rally is probably not all that likely. I think it's unlikely Bitcoin is going to be able to rally 343% necessarily in this run, but why further upside might be possible, or why there's a lot of similarities between what's going on right now and what happened in 2019. So to do this, I want to talk about different models that we have here at the channel, and these are all available over at polaritydigital.io. This is a website that we have launched in collaboration with Jay over at Daily Crypto Analysis. Leave a link to the site and to Jay's channel in the description. Recommend you go check out both. And I want to talk about a variety of different models and how they're looking, kind of eerily similar now to how they looked in 2019 going into that big run. So we're going to start off by talking about the short-term UDPI, our risk indicator, or one of our risk indicators, momentum bias indicator, trend confidence indicator. We'll also talk about the market direction classifier. So to start us off, I want to talk about the short-term UDPI. So this is our risk indicator. So basically higher levels as you get closer to 5 being high risk, lower levels being low risk. You can see it really spikes up, at these market cycle topping points and then gets quite low at these kind of low points, these bottoming points in the market. Now this cares about this particular version of the model. The short-term cares about moves that play out over days to weeks. So it's reactive to this shorter-term volatility than something like our long-term UDPI, which is really more macro in its focus, catching the broader moves in the market cycle, whereas the short-term UDPI is trying to capitalize on some of that shorter-term volatility. So what I wanted to do is go ahead and focus us in on data from 2019. So I'll start here, 2019 through to now, just to kind of orient ourselves. So what we saw in 2019, was this big, run up, and we really saw was this double peak on the short-term UDPI. You'll notice it was, 1.22, about 1.32 was where these two peaks were. But, right around this general kind of rough area where we had this big run, this one big thrust up that then the model was saying, all right, we're getting a bit overextended in the short term. Sure enough, we cooled off for a while. Risk cooled off for a bit. The short-term UDPI fell down into the negatives. Then off we went again for that second peak, which then ultimately was the top of that run in 2019. You'll see this oftentimes with rallies where you'll have these initial impulses that really shoot short-term risk up. Then you have to spend some time cooling off, and then you'll go back up again. We actually saw this play out here in early 2021. We had this big run up into January of 21. Short-term risk cooled off a bunch, and then that allowed Bitcoin then to run up to this kind of second peak up at 55K. Then that led into this rounded top before the big crash. Now over here, what we're seeing in this current rally that we're doing is, look at this. We're seeing short-term risk came up to around 1, so a similar level where we topped out back here in 2019, got rejected back down to the downside, fell off. But now it looks like we might be rounding the corner again. Risk has fallen quite far, down to negative 2.24. And now as price is moving back up, is it possible that we're building into this kind of action here, where we might be, rounding the corner soon with risk? You can see it already starting to slow down in its descent, and then maybe go up if this rally here can continue. Too early to know, obviously, if Bitcoin's going to be able to follow through and break above this range to new highs, and start testing some of these previous levels potentially. But it's a hypothesis. It's a possibility to keep in mind that you often see these kind of double impulses on risk on the short-term UDPI. This big move up, that's represents itself as a double top on short-term risk. Big move up, consolidate, big move up, that's the top. Big move up, consolidate, big move up, that's the top. Or in this case, very near to the top. So here, could it be this big move up, cool off, and then maybe move up to the actual top? We don't know, but we'll have to see. But if that is the case, if there is another push up that ends up being the top, of that run like it was in 2019, that'd be consistent with some of the things that I talked about in previous videos, where I did not think it was likely that Bitcoin will be able to move, 340% to the upside from the low back here. Diminishing returns are a thing, diminishing volatility. That as Bitcoin has gone on in time, each rally has been able to go up a fewer number of percent. Each rally has been less impressive in terms of multiples than those rallies before. Now, every market cycle, the peak has come at a lower point percentage-wise relative to the low than in previous market cycles. And so it's reasonable to expect that dynamic will continue with any kind of rally if it continues here. So I talked in previous videos about how the kind of 30 to 40K range might be interesting to look at. And then who knows, depending on how the short-term UDPI reacts, maybe even somewhere in this general level, the high 20, low 30Ks might look reasonable. But I would think somewhere in this general ballpark might be more of the target if we could see a continued run. Too early to know that yet, but I think it is plausible. And of course, there's going to be other signs we can look at as well, but this is just one thing we can look at. So that's the short-term UDPI. Let's go ahead and talk about a different model here. This is the MBI, or Momentum Bias Indicator. It looks at momentum in the market. And what is the prevailing momentum? Is it prevailing to the upside, like you see in these bull markets, or to the downside, like you see in these bear markets? So 0 is the average amount of momentum an asset has seen in its life. And then each unit beyond that is denominated in standard deviations. So 1 above 0 would be 1 standard deviation above the mean. -1 would be 1 standard deviation below the mean. So we saw here was textbook bear market behavior, right? We talked about this before on the channel, where we had these kind of failed attempts to reestablish positive momentum bias, but then just getting sent down into the doldrums of this really negative momentum, and then just not being able to break out of that until this run here, till more recently. Now we are rolling over, the momentum has slowed down quite a bit, since that initial impulse, not particularly surprising. Let's go ahead and zoom in again, like we did before, so we can see this a little bit more clearly. So we're just gonna have, pull this back over here, just have data from around 2019 onwards. So you can see in 2019, we shot up, we went up to a similar level we were here, we came back down, not quite as far as we have this time, but similar level dip, and then off to the races we went, up, kind of cool off, and then up we went again. Now, this would be more analogous to this first move, whereas the short-term UDPI is saying it's more like the second move. But either way, even if this was like the first move, it's not unexpected to see these kind of waves happen with momentum. You get this first burst, come back down, you might get that second burst, and then come back down. Whether or not that marks the top or just another intermediate point, like it did here, that would be to see. But just to look at the MBI rolling over does not mean that this means that the rally has to be over, because this happens very often. So I think if we see this continue, and certainly break out of this range, what we're going to see is this roll back up, and then we might go up into these more extreme levels where a local top might be more likely. So it could either be like this, where we still have kind of a few more stepping stones to go for the top, or it could just be, like the short-term UDPI might suggest, just a big race to that ultimate top before we cool off from there. But again, depending on how it all shakes out and how it interacts with some of these levels, one of those scenarios will be more likely than the other, and so we'll have to see. Like, for example, if we rallied up to this point, I wouldn't say that that would necessarily mean we'd have to be at the top of the rally, and I would suspect the short-term UDPI might not be as extended if we just got up to that point. We might need to go further to get there. So there's some data that we'll be able to look at to see if we would be doing this kind of stepping stones to the ultimate top, or if that next impulse would be the top itself. But certainly the model thinks that that would not be impossible. Now, the other thing I wanted to mention with the MBI is that even if we do, fail to break out here, it's not necessarily a bad thing from a long-term perspective. What you'll see in kind of transitions out of bearish periods into bullish periods is this kind of oscillation around 0. I talked about this many times in the past. So what we might be setting ourselves up for is some of that right here as well. If we just consolidate in this range, it might not necessarily be a bad thing. If we just see the MBI consolidating around 0, that could just be setting us up for bigger bullish move in the future. So, if we don't get this rally that I'm saying is, possible, not guaranteed, obviously, but possible, still not the end of the world from a long-term perspective if you're hoping that Bitcoin can have some positive price movement. We just might need to be more patient and wait a little bit longer. All right, let's talk about a different model. Let's talk about the trend confidence indicators. I haven't talked about this indicator as often on the channel, but I think it can give some really useful data, and especially in kind of context where we are right now. So I wanted to pull it out and talk about it. Now, one of the things that's really useful about the TCI is that I can give advanced warning about trend changes or trend reversals. And I'll talk about what I mean by that. So the way you can interpret the TCI is that being above 0 is kind of a bullish sign of, indication that the model thinks that things moving in the bullish direction could happen. More specifically, it's getting more increasingly confident in the development of an uptrend the more positive it gets. And then the more negative it is, the more confident it is that you're either in a downtrend already or you're soon going to be in a downtrend. That's kind of the way to interpret it. Positive values and more extreme positive values are greater and greater confidence of either currently being in or soon to be in an uptrend. Negative are soon to be or already in a downtrend. So take a look at what happened back here coming out of this crash into 2019, where the TCI went down saying, yep, definitely in a downtrend here, which no surprise. Then look what happened through this entire time here. This entire time when things were probably looking quite bearish, probably a lot of people were calling for lower and lower Bitcoin prices, the floor to fall out one more time like it did here, the TCI was saying, no, not a chance. Or not a chance, but not in its mind. It was actually relatively confident that an uptrend would start to form soon throughout this whole time. And then sure enough, look what happened. Off to the races we went, shooting up to the upside in 2019. But then importantly, you'll notice what happened. It stayed confident through this whole time, started to get a little bit uncertain through here, but then quickly, revised itself and said, all right, one more push up. But then after that, it said, all right, that's probably it. The trend seems to be exhausted. It's not very believable anymore. Don't necessarily buy into it. And then, down we went. Then, through here, it started to be thinking that, maybe this downtrend is starting to weaken as through here. And then an uptrend was forming. And then right when we get to here, it says, oh, something's wrong. Crash we had into March 2020, but then very quickly again it went positive, saying uptrend is seeming like it's forming here. It was weakening, uptrend forming, weakening, and now off to the races we go, up through here. And you also see those divergences play out here, price trending up through this rolled over top here, TCI trending down saying get the hell out. Same thing here, downtrend through summer of 21. TCI actually saying this is a great sign. This is looking very much like an uptrend, and indeed that's what we saw. So basically across all these different times, you can see how the TCI can act as this leading indicator. These divergences between downtrends or seeming downtrends and the TCI suggest that, maybe this downtrend is weak, not very convincing, that can lead to upside later. And we actually saw something like that play out through here where we got this crash, back in November. But then you see the TCI kind of trending up here and kind of hanging out in the positives. And then off to the races we went. Now you'll note that we did dip down into the negatives, and now we're kind of going back up to the positives with this movement up today. And what's interesting is that this looks eerily similar to what we saw back here in 2019. In this case, this early point in that rally, where we came down, we dipped down right below it, and then off to the races we went to this next leg up. So obviously that's no guarantee that we're going to see that next leg happen here in Bitcoin, but I think the similarity is just interesting. And obviously, I think it goes without saying that I'm not expecting price to just play out in the exact same way that it played out in 2019. That's obviously not the case. Price will never play out the exact same way that it did in the past. But we're just looking for analogies or things to compare it to. I think it's an interesting comparison point. And that's why I'm not going to sit here and say that I think that we're going to see this kind of massive explosion to the upside from here if we do see a continued rally. I think a more realistic perspective of where it ends up being kind of in this range between, kind of the high 20Ks, 30K, maybe at best 40K is kind of where I would see that being. But I just think when we're comparing these, it can be a useful guide because we've seen this play out before, kind of these rallies where you kind of dip down, where at the time it probably felt like this was just, this was just another failed attempt to kind of move up and break out that was going to roll over. But then we saw that breakout. And so I think keeping an open mind for this hypothesis that maybe we can see further upside is reasonable, and what data to keep an eye on. And you see the TCI continue to reverse to the upside here, that would be a bullish signal. Now, the final model I want to talk about here is momentum bias indicator, the market direction classifier, MDC. This model is quite easy in its interpretation. Basically, it just creates this critical level that it thinks if price is above that, that's bullish. If it's below it, that's bearish. And specifically, these flipping points are important. When you see price cross below or cross above the critical level, that often leads to notable downside and notable upside. Upside, downside, downside, upside, downside, etc. And so when you look at this, just zooming in a little bit, you'll see how it can catch very early on these big moves to the upside and then get you out pretty quickly after that run. And even in these kind of fake out points, it'll roughly get you out at break even or actually a little bit positive. This one here actually would have gotten you out a little bit in a positive footing there. It sets its critical levels so as not to lose money, or that's generally speaking. It's vast majority of the time it'll be break even or actually slightly positive. And what you can see if we just look at what happened more recently is we crossed above the critical level all the way back down here at about 17.8K after the races we went. And now we're not even close to the critical level. The critical level's at a little under 19K, nowhere near that. And again, if we look back at 2019 as being a comparison point, this looks awfully familiar, right? Moving up, coming down, then reversing back to the upside, moving up, reversing down, reversing back to the upside. There's some similarities we can see. And really until we go back down and start breaking below the MDC, from this model's perspective, there's nothing to really be too worried about yet for the uptrend. And so that's kind of what I'm going to be keeping in mind, is that no matter what people are saying, no matter what the narratives are, etc., if we stay above the MDC critical level, that's at least 1 point for the bulls. That remains. And and if we go back down and we were to test this level, you'd see a lot of bears saying, game over, we're going down to 10K. But if we can hold that level, or in this case, stay well above that level, from this model's perspective, there's nothing really to be too concerned about yet. And certainly, from its perspective, the good time to be getting in was right around here. And then, even if you got out at 19K, that's still a profit, going from 17.8 up to 19K. That still would be a profitable trade, even if it's not capitalizing on this volatility up here. But I think it's plausible that we see something like 2019, where we really start shooting off to the races, and then you might see the MDC getting a bit more aggressive in where it's setting the critical level, and then trying to kind of catch that critical point when we're breaking off of the highs, maybe going to start a new downtrend. So again, speculative, going to have to wait and see what happens, but that's one of the other data points that I'm going to be watching. So to wrap this up, I do want to say very clearly that there's no guarantee at all that we see further upside or that these things play out like similar to the way they did in 2019. The main point I wanted to make with this video, though, is that if you just look at what's going on with not just price action, but really with the way that these different models are behaving and compare it to something like 2019, there are similarities that are notable. And it should be treated as a hypothesis. And that's kind of the way that I would think about this, is that I think there's a very plausible possibility that we see further upside like we did in 2019. And there's some things that are looking consistent. So it's a hypothesis that is not invalidated. In fact, it seems very reasonable to hold that hypothesis right now. But hypotheses need to be tested, and so it's something that you need to keep an eye on. And there's certainly not things that, in my mind, makes sense to just go all in on it or to think are guaranteed, because that's never the case. It's always something that should be looked at probabilistically. What are the data telling us, and how likely does that make that hypothesis now? How likely is the bearish hypothesis versus the bullish hypothesis? And taking the data to make those evaluations. So none of what I've said here is financial advice. I don't want you to interpret it that way. I want you to look at the data for yourself, make your own judgments and opinions. But this is one of the things I'm seeing right now. And I think it's reasonable that this could happen. And I'm not seeing sentiment in the market yet that gets me all that concerned, in the sense that I'm not seeing people being so outrageously bullish or overly bullish that, there's kind of a contrarian signal that we should now be bearish. In fact, I think with the more recent pullback with Bitcoin, what we had seen is that a lot of, people who had maybe started to get bullish through here flipped bearish and said, all right, it's over. We're going back down to, break new lows. Now, with this rally, we might see that change, but we'll have to wait and see. And I think if you just look across some of these other models, there's a story that can definitely be told that be consistent with more upside being very realistic. So, not financial advice, should make your own opinions. Those are some things that I'm thinking about with the market right now. All right, if you like the content, or subscribe to the channel, give the video a like, go follow us on Twitter, a lot of updates about our indicators and more, and go check out PolarityDigital.io. I'll leave a link in the description. All of our models here, live data and historical charts that you can look at. And while we're in this beta phase of the site, it's completely free to access.